Welcome back to Market on Close. I'm Oliver Renick. It's time for the closers panel with just about 11 minutes until the end of the trading session. I'm joined by Mackenzie, the Managing Director of Futures and Forex and contributor on the TD Ameritrade Network, as well as Bob Iaccino, Founder and Chief Strategist at Path Trading Partners. Bob, great to have you back.
Good to be here.
As always. And we've also got a first-timer on the panel, right? George Tsilis. In the flesh from Salt Lake City, contributor on the network. George, great to have you here as well.
Likewise, good to be here, Oliver.
All right, Bob, let's talk about the market today. As you just put it in right before we came to the show, when there's no headlines, it seems to be a pretty buoyant market.
Yeah, it seems to me that bullish undertone that used to affect almost solely the Russell, when it was all about tariffs, it wasn't about currency crisis in Turkey. We sort of used to get people hiding out in the Russell, wanting to own stocks, but not necessarily wanting to own that global macro story, given the potential for damage to the global synchronized growth with the tariffs. Now what we have is we've got more of a currency crisis, which I thought should spark gold and hasn't. But having this currency crisis, it seems like we get these headlines, whether it be tariffs now or potential contagion from Turkey. And when we don't have a headline, the market rallies. Almost like people kind of have these extremely short memories. It shows this desire to be long. But I not only have concerns about that sort of approach to trading / investing, but I have some concern about the overall market as well. And I'm not sure it's a strategy that's going to last. I'm still bullish for 2018, but I've kind of dropped myself to maybe middle single digits in the S&P and low double digits in the NASDAQ by the end of the year.
The Russell and the NASDAQ, as you put it, basically took on a life of their own, and it didn't seem like anyone wanted the S&P, the Dow especially, there for a solid 3 to 4 months. JB, you look at the participation now that happens with some of the big caps. Yes, today the Russell's leading, but you see gains in the Dow, you see gains just about everywhere. The S&P's up the same amount as the NASDAQ. Is that breadth good, or is that breadth worrisome when that kind of steamrolled into a market top, at least so far, that happened in January?
I mean, I think we wanted to see the Dow participate, and we've been wondering where it's been. It's been sort of, we've talked about the fact that the tariff talk has really seemed to crush any momentum that the Dow has been able to bring in there. And meanwhile, you look at the Russell, it kind of keeps churning along. And NASDAQ, you've had sort of that rotation, and everybody's feeling a little bit stronger after that sort of FANG sell-off. I think it's good to see them back here again. I'm very curious to see, can it sustain when this dollar keeps rallying up, and does that have a bigger impact where it starts to depress back down those Dow components again?
Yeah. Well, it is kind of a different environment when we talk about more big companies taking part, right? Because there was always a caveat when the Russell and NASDAQ was like, hey, Russell and NASDAQ making new highs, but what exactly does this mean? Does it signal this is kind of the last, umph push for growth-oriented investing? George, what do you make of the disparity that is now kind of closed and you see that breadth return?
Well, I think when we actually take into consideration the NASDAQ and the growth stocks, the Russell 2000, moving to the upside based upon some of the dollar strength, the Dow components are still a little bit iffy. I mean, today we even saw the Turkish market move to the upside by about 10 or 12%. It was really based on just maybe a rebound, if you will, just kind of a bounce back associated with that movement to the upside.
Yeah, it certainly wasn't on banning iPhones, was it?
No, I mean,
I don't know. I'm speculating. That was kind of a joke.
Well, I think at the end of the day,
didn't quite get the reception I was looking for.
I think at the end of the day, we certainly have to take into consideration credit conditions and debt conditions right now. We did see a little bit of a move to the upside in the 10-year rate, but the short rates are also rising considerably as well. So that's pretty buoyant for the dollar, but we actually saw the dollar and rates move to the upside, as well as the Turkish markets and the emerging markets move to the upside. So I think we're actually getting a little bit of a pushback from that aggressive selling that we got the last few days or so, associated with the potential now, I would call it a currency crisis. It's not necessarily manifested into a debt crisis yet, because if you take into consideration Turkey on a relative basis to a country like Greece, obviously it's a larger economy, closer to $900 billion relative to Greece, about $200 billion. The debt conditions of Turkey are not too bad on a relative basis. So, I think that's where maybe the market got a little bit overblown associated with this particular currency crisis, because it's not really manifested just quite into a debt crisis.
Bob, is it right for the market to kind of move through this as quickly as it has? I mean, when this news broke on Friday, was the vibe around you with traders, oh boy, this is happening with Turkey, we got to be careful? Or was it, hey, do we care about Turkey?
It's strange. One of the things that came up was the potential for a very positive event around this sort of Turkey narrative with the potential release of the pastor. Now, I'm not saying I know of any potential release.
Yeah.
No one in either government called me today, oddly enough.
Yeah.
But if this American pastor were released, theoretically, that takes a big kind of foot off the neck of Turkey, especially
in terms of the sanctions?
In reference to the debt, because they borrow a lot in US dollars, in reference to the sanctions that was put on when this pastor was well, when it came to light that
Sure.
had been captured. So that has the sort of, if it weren't Erdogan running the country, that has the potential to actually take care of itself very quickly and take a big foot off the neck, as I mentioned.
So it might be leadership risk in a sense.
Yeah, and then there's obviously, again, it's not necessarily a debt crisis. Yeah, 21.46% Turkish debt might sound horrible, but that could be 15%, again, almost overnight.
In terms of what, European bag holders of that? European
Yeah,
banks or what?
and the contagion being sort of quarantined off.
George?
I mean, in terms of it being an emerging market, what's interesting is we're seeing China. Its currency has been to the downside, but I think what we're seeing in Turkey is not necessarily some economic risk per se. Right. They are running trade deficits. They do import quite a bit of gasoline and automobiles. That's generally dangerous for an emerging market, which is contingent upon export-led growth. But I think it's really a political issue, and I think it's been manifesting for quite some time. And then you have the pressure of U.S. rate hikes. That's actually adding pressure to the dollar, and that's actually, again, adding pressure to the funding currency, primarily the U.S. dollars, especially at the private sector level, which is really where the concerns lie. And again, who owns that private sector debt? Is it a Spanish bank, a Swiss bank, and so forth? And it's all this perception, I think, that has gotten a little bit out of hand per se. Because if you look at, again, the ratios, the debt conditions itself, it's not all that bad on a relative basis to other countries, which is Greece. But again, they didn't have a currency crisis. It's more of a debt crisis because they're locked in with the euro.
Well, I'm glad that Tim Mulholland brought up the China 2015 situation, because in the background of this, the yuan has kind of continued to keep weakening. I guess we had a few moments to focus on a different currency, blowing up. But JB, if this is indeed a sort of political issue, I think that's a good point to bring up, because it changes the set of catalysts then, and it changes sort of what traders and investors have to look for. And if that can be resolved, with the release of an individual or an agreement made by parties, kind of how the market is waiting for that to happen with tariffs, then we go back to whatever the situation was pre-Turkey. But that still involves a weakening yuan, a tough emerging market story with the dollar stronger, and more of kind of the same that's now just been maybe exacerbated by Turkey.
Absolutely. I mean, I think that's the story out here, is the fact that the yuan has been really hurt over the last few months, especially with not only the tariff fight back and forth, but really this U.S. dollar. This U.S. dollar marching the way it is putting more pressure. You've already seen the Chinese government step in and try to prevent the shorting of its currency continually, really trying to give it a lifeboat here, I would say. The question ends up being is if we continue to increase interest rates and we start hitting these deadlines and tariffs actually go into place, I think it'll be very interesting to see what happens, especially if this dollar keeps going up. Because remember, we're 2 weeks away from that next round coming through. And by the way, 2 weeks after that is the expected interest rate hike in the U.S. market. So you have two big events within a month that a lot of people maybe aren't paying attention to because of the fact that Turkey's come to the front of the news cycle.
Yeah, there's a lot of people looking at different countdowns for the Fed. You've got the Bitcoin countdown. I think we should be having a Chinese tariff deadline countdown, right? I mean, because yes, those deadlines can get bumped pretty easily, but that's a pretty big deal for the market that could unleash even some of the fundamental stuff we heard from companies who had to revise all their guidance down.
And this is that stuff outside of the traditional agricultural products and aluminum and steel. We're talking now about consumer-based products. Yeah. That consumer-based product now, all of a sudden, that pressure, that hits home a little bit more for us, but also there as well. So I do think as you start to adjust it around and look at it, it's going to be, okay, well then what comes next? Then this, to me, the tick and tack goes back and forth, and how are they going to respond, and then how are we going to respond? And it sort of can escalate very, very quickly.
Yeah. Do you have these dates on your radar as a trader, Bob? Is this going to be a different market after the 23rd or whenever that deadline comes for the various tariff negotiations that are happening? Is this going to change the dynamic of investing?
We do. We definitely look at that. I mean, we have all the major dates that are kind of targeted, and those are in pencil. Yeah. Because as you said, those can be moved around. The interesting thing for me when you talk about the tariffs is you're looking at a situation where we have, I believe, 91% of the S&P 500 has reported actual earnings.
Right, yep.
And you've got really good EPS, 79% of beat, really good revenue, 74% of beat. The biggest negative being of the 74 companies in the S&P that issued guidance, 55 have issued negative guidance and have mentioned tariffs. Then you go down one metric more. When you have the companies that get 50% of their earnings from inside the U.S. underperform the companies that get 50% from outside, 50% or more from outside the U.S. So that means tariffs haven't hit yet. And we got a slightly lower blended earnings growth rate so far than last quarter. So if last quarter was peak earnings, and if tariffs haven't hit yet, and if tariffs continue to get implemented, it's a concern. It's a macro concern going forward. So you have to look at those dates, to your question.
Yeah.
You have to look at, we're getting any better in those types of situations, because those particular sort of scores that I just rattled off as if I wrote them, which I didn't, those particular scores get worse, not better, and there's no real hope for them to get better.
Sure. Real quick, George, last point before
I
we
think
go
it's
to
a great point you bring up, because if you actually take into consideration the recalibration of estimates going forward, even though the tariffs themselves, from the scale or scope of them, may not necessarily manifest to some huge event, it's all about the expectations and the recalibration of those estimates, which can of course be discounted to what we're seeing in the markets right now.
Stocks have to be repriced.
All right, let's take a short break. We're going to be back in about 60 seconds for the end of the trading session and more commentary from the closers panel on the TD Ameritrade Network. Welcome back to the TD Ameritrade Network. The S&P 500 ending the trading session roughly 64 basis points higher in the index, slightly less for the futures. The Dow Jones Industrial Average 24,732. That's the end of a 4-day rout. Boy, was it a tough one. Not really. The NASDAQ up about 0.6% as well. So even with debate and here excellent analysis on what the Turkish situation means for markets, equity investors, at least for their part, shrugging that off as the Russell climbs 1%. 10-year Treasury also trying to make some upside momentum, just below 2.9%, but nowhere we haven't been before. And that's where I want to bring in the closers panel. Bob Iaccino, George Tsilis, and JB Mackenzie are still with us, guys. Coming back to the market and our subject about big cap participation again, Bob. There was a report a lot of folks covered in the media today about Bank of America's fund manager survey. I used to write about it in my last job, and they call a bunch of institutional managers and they ask them how they're feeling about things. And they are most bullish on U.S. as a geographic investing area, more so than they have been in quite some time. And I wonder, given the fact that the 10-year still is at 2.9%, all right? You probably know where I'm going with this because we talked about this. Is this kind of post-TINA trade that still exists where there's not that many alternatives yet, and investors just look around and they go, boy, now you've got all this geopolitical stuff going on, I'm just going to go back and buy S&P 500?
Yeah, we've seen global surprise indexes go negative on all the major economies and recently on the U.S. Now, the U.S. hit the flat line again, I believe, with the last batch of numbers.
Just looked at them before we came on.
Yeah, so it hit the flat line again. So it's really kind of theater of the obvious to say that we like the U.S. They could have almost skipped the survey at this point. I like the U.S. I mean, and I still like equities. I like equities for 2018. It becomes, to me, a little bit more of a stock picker's market, a little bit more where you're looking for discounts, EPS discounts or discounts to sector, whatever it is you look for, EPS to the index. And the thinking to yourself that you might end up holding them a little bit through possibly some harder times, but those harder times are likely to end. I mean, you can't ignore the midterms. You just can't. It's something I believe is.
Do you think this is going to be a market volatility-inducing event?
I think there will be actions taken to stabilize the market or rally the market to the degree they can be taken as we approach the midterms. Because the one thing that the sort of Republicans have to run on is that, you know, to use a phrase I don't particularly care to repeat, your 401k looks better.
Sure.
So they want to keep saying that. You don't want to see a 15% correction going into the midterms. Well, they don't want to see, I should say. Nobody wants to see it. But, you know, and I think it's something that's going to affect crude oil as well, so it could affect energies. I mean, there's a lot going on, and this is the first time I can remember saying the midterms might affect equities. The first time I remember saying that.
Well, what I think is also going to be interesting is just sort of how the market responds to what happens. I mean, as you guys all know, we don't talk a lot of politics, but in terms of assessing what the market cares about and how it feels with the outlook, so far the street seems to have been, I mean, just look at what happened post-election. There was a clear vote of confidence in what this administration was going to do back in November 2016. And then since then, we've continued to see new highs. But you kind of had this mixed bag where a lot of folks on the street like tax reform, a lot of them don't like tariffs. And now whether or not how the market responds to any leadership shift, George, I think that also becomes pretty interesting in trying to figure out how investors view the political landscape here in the U.S.
Yeah, I would say post the midterm elections, we may see a positive lift based upon the fact that these tariffs may not actually come to fruition as deeply as expected.
Right.
I think what we're seeing right now is a push towards, hey, you know, the United States is, of course, a premier nation. We have to do a pro-U.S. based policy. Of course, it's creating some spillover effects and draining the rest of the world from reserves from the rest of the world. We're seeing that again play out with of course, Turkey and of course China's market to the downside and the currency to the downside, those kinds of things may actually reverse. And that might be, again, pro-Dow stocks based upon the dollar maybe weakening post that particular election. So again, overall, I would say that this is going to be a big, pretty big event as soon as this passes through, and then going forward to say, hey, we're back to sort of normal operating procedure, so to speak, when it comes down to markets operating on markets, not necessarily based upon policy or perceived policy changes.
Yeah. Speaking of normal or not normal markets, I want to talk about volatility for a sec. VIX, again, lower today, JB, down to just below 14 once more. I mean, this is kind of the trade where when we talk about investors liking the U.S. again, buying those big caps, the VIX remains muted. It does start to sort of add up pieces that look more like the start of the year than really at any other point in 2018 so far.
Yeah, I mean, if I'm looking right now at this market, you're seeing a little bit of a pop and some volatility, and then once sort of things settle over a day or two, we go right back into where we were, and it seems like we hold there for a couple of weeks. I would make the argument you have the same thing happening on the 10-year, right? We keep talking about 3. We drop below it, we work our way back up, we come back down below. I think when you're looking at that from the VIX standpoint, however, is people feel really good. The quote-unquote fear or concern in that marketplace really isn't there. And I think Bob made a point earlier that's really important. Is gold has not participated, and you want to see gold participating if there is truly concern out there in VIX, and you're not. You're watching, I mean, it's sold off through this whole entire Turkish issue, so that just tells me more and more that market is sort of complacent with where we stand from a volatility standpoint, and then really earnings are what mattered this past quarter, and that's gonna trump all of those other concerns until we get through this tariff talk.
Yeah. At what point does it just lose the, its use as a sort of way to gauge any degree of sentiment? I mean, it's like pick an event of 2018. Nothing's put at life into gold. Nothing.
Yeah, I mean, I think this is going back to a conversation of our traditional metrics or traditional ways we've viewed volatility in the market. So whether it was looking at bonds, yen, gold, and VIX, all 4 of those aren't participating in the way we would expect to if there is a little bit of geopolitical risk out there. So therefore, you're having to find those new ones. One of the things we had talked about is, do you see that more now shifting toward those FANG stocks in the NASDAQ because of the fact that it seems to be the one area immune to everything when it comes to tariffs? Are these technology and these FANG stocks because of the fact that they're growing everywhere and they're still finding ways to be part of our overall economy? Therefore, is that where you're seeing and why you're seeing that retail participation still continue there?
Yeah, that's an interesting point. We've had this debate quite a bit, right? We have some folks come on that say this is going to be the group that keeps you alive when things get rough. Others come out and they say, George, this is crazy talk, all right? Tech is high beta and tech is tech for a reason. When things go south, they're going to go south in a big way for this group. Where do you land on this debate, GT?
Well, eventually they will, OJ, but at the end of the day, we have to consider what's happening with what the funding markets. We're fully funded. I mean, This is not a market where we're actually saying, is it stocks versus bonds? They're actually both moving nicely to the upside overall. The 10-year is still relatively flat. Market's doing well. There's no demand right now for fear-based trades like gold right now. Volatility is very low. Let the rest of the world fund our markets, and that's what's happening right now. Again, that can certainly change at some point in time, but I think when we actually start moving into the later stages of this particular year, we may end up getting into that point where markets generally move towards the end of the year to the upside, which actually may fill in some of that gap, so to speak, when this whole market-based election standstill, if you will. The market's just kind of hanging on there and waiting for this particular event to pass. We may end up getting back to a normal-based market where we start to see some outflows into bonds, back into stocks, and so forth.
Right, which was supposed to be this year, Bob, but it seems like 2018 is shaping up to be, if 2017 was you can be just an unashamed, loud, obnoxious bull, this year it's just, it'd be a little bit of a quieter bull.
What do you do when the dollar is the economic buy, the dollar is also the crisis buy? You barely even see reaction in the Swiss franc. I mean, the yen held up today, but still down 32 basis points against the dollar when I last looked at it. Swiss franc was up a little bit and everything else is down. Again, going back to your question about the survey where they all said, you buy the US, I mean, that doesn't necessarily mean we're going to see an S&P up 16% and a NASDAQ up 21%. I've mentioned this on the show before, that outperforming doesn't necessarily mean you earn double digits. You want to outperform to the downside. That's really where your guys' clients want to do better. I mean, if the S&P is down 40%, you guys want to help them not be down 40%. I would assume that's your goal. So it doesn't necessarily mean outright bull, but comparatively, I mean, it has to be that way.
Let's talk, shift gears here for a sec. Let's talk crude while we got you, because it is having some trouble bouncing back the way we've seen it the past year. What do you see as being the biggest weight here, Bob? Again, today it looked like it was going to make upside moves, got hit right back down.
Yeah, short term, the rally's over. You're looking at crude oil heading into that area. I mentioned to you before that the seasonality generally tops out around late August, early September.
Yeah, I mean, some of the names ultimately, when we're talking about the retailers, the branded-based companies, of course, Tapestry came out with earnings today. And I think what we're actually seeing here is just an improvement in gross margins of these branded-based companies and pricing power. That seems to be the name of the game when it comes down to a lot of these names, Tiffany's, the Ralph Lauren's, and so forth. It's improving those gross margins. I mean, I think also one of the interesting things to mention here also is what's going on with these consumer discretionary-based companies like the Macy's of the world, the Nordstroms of the world. I think we're actually see some value being chased right now in these names. It's really about those value-based names, lower multiples, lower price-to-sale based businesses. And overall, the retail space has done very well, but now I think we're going to see some divergence from just some of those marginal-based companies to those that are actually performing double-digit revenue and EPS growth.
Yeah. Bob, are you interested in this group from either that sort of rebound play or from those that are truly expanding the business? I mean, or is it just too murky here?
Well, I ignore the high-end retailers completely because I just can't figure out who's going to beat who. Yeah. But I love the value-based. I mean, we like Kohl's. I could digress a little bit into, we like Aaron's, which is not directly retail, but it's sort of a furniture rental business. When jobs are doing better, I think those value retailers get a bigger boost than the luxury retailers who can be consistently good,
right,
regardless of whether jobs are doing better or not.
That kind of acyclical.
Yeah, and that bump up in jobs is probably 18 months old, so I think there's still a little bit of legs in that particular sector of the market, to your point.
Yeah, that kind of reminds me of the Home Depot story as well, and some of the home improvement, as opposed to maybe new homes. I mean, there's a sort of cyclical versus non-cyclical type of a story there, maybe.
Well, yeah, again, as the jobs market is going, I like the people who are getting the jobs to spend it at a lower level. That's kind of what we've seen in the past.
Oh, just to add, I was going to say, in terms of companies like Kohl's, it seems like the market is starting to reward those companies that have good balance sheets and have low debt. And I think we're starting to see that in the Kohl's, the Costco's of the world, and even the Walmarts of the world, which are actually now starting to demonstrate some movement back to the upside.
Tom White and I talked about the options ahead of this, George. Close us out on this point for the sort of sector, because there's super high implied volatility going into these earnings. We've seen names like Kohl's the last time around drop 8 to 9%, basically like that. Is this going to be a more sort of big swing type trade in these companies as their outlook remains, what, dubious, visible, or?
Well, I can speak a little bit for Walmart. If you take into consideration the capital expenditures they've had to make has been very considerable on a relative basis to pure-based companies, because they're competing head-to-head with Amazon. So Walmart has suffered based upon CapEx, not necessarily returns on shareholder value or even share buyback. So they've been very aggressive. So this will be interesting to see if some of this capital expenditure that's been made in this company the last 2 or 3 quarters, because the price performance of the stock has underperformed, whether that's actually going to start to manifest going forward. Yeah, that's what I'm looking at least for Walmart.
All right, there we go. We got Macy's tomorrow morning. We'll get some answers on this. We're out of time, though, here. We got to move forward. Bob Iaccino, great to have you back, as always. Thanks for joining us, sir. Founder and chief strategist, there we go, Path Trading Partners, as well as George Tsilis joining us on the panel, and JB Mackenzie. Guys, great stuff, as always. Much appreciated for the excellent analysis of this market today and some of the big picture stories.